This Week in the Boardroom, brought to you by corporate board member and host NYSE Euronext, along with governance knowledge partner Paul Weiss and contributing partners National Investor Relations Institute and the Society of Corporate Secretaries and Governance Professionals.
Welcome to this edition of This Week in the Boardroom. I'm TK Kerstetter with corporate board member. And once again, it's my pleasure to welcome my co-host, Scott Cutler with the NYSE Euronext, and our special guest today, Stephen Lamb, partner with Paul Weiss, also is the former Vice Chancellor for the Delaware Court of Chancery. And welcome, gentlemen.
Thank you. Happy New Year.
Yeah, this is going to be a topic that lets me get on my high horse a little bit, because we're going to be talking about the legal ramifications of risk-taking and short-termism. Whenever you say short-termism, you know, you're always talking about that quarter-to-quarter pressure that companies feel that one may think is sort of unfair. But my question to you guys, and I'll give you the scenario, is really going to be, what is the long-term effect of short-termism on U.S. companies? Let me give you a perfect example. I'm a company that's going to expand into, let's say, an emerging country. And I know that there's a significant investment in that that's going to affect my earnings on, let's say, the next 2 quarters in a major way, okay? So all of a sudden, I come out, I make the proposal to the board to say, here's what we want to do. The board's nervous about that kind of number because they feel that if they miss the quarterly numbers, the stock price is affected. There's a possibility for a suit that follows that for those people that bought stock in there. So that kind of pressure impacts what somebody's willing to do in their long-term plans, okay? We've all discussed this argument. So what effect does, to set the base here, what effect does short-termism have on U.S. companies? And Scott, I'll start with you.
Well, if short-termism is like the children's story of the baker's dozen, which means that you're pulling out ingredients to sacrifice the good for the short-term profits, obviously it's going to have disastrous results over the long term. The challenge with the argument that we've set up today is part structural, in that when you think about the responsibility the company has to its shareholders, the time horizon of many shareholders is very different. There are shareholders that have a long-term focus, but there are increasingly a number of shareholders that have very short-term focus. That could be minutes, microseconds, days, weeks. And the importance of management communicating the long-term strategy and directions of the company has never been more important, especially when that communication is to investors or companies that may have a concentration of investors that have a short-term, more of an activist type of role. And so I think the challenges has to be addressed largely through communication. I think the other thing that my advice is that oftentimes strategy does have to change and evolve. And again, if strategy is going to change and evolve and it's going to have direct impact on quarterly results, and those investments need to be made, then that needs to be disclosed, it needs to be communicated, you need to have shareholder meetings, it needs to be broadly discussed, and management must take an active view in terms of the communication of what that long-term benefit is and the short-term consequences. And I think if you do that appropriately, you stand in much better grounds from a legal position.
Stephen, anything to add?
This made me think of the study that the Aspen Institute did in 2009. And they published a couple of different papers, but the one I got out and looked at is called Long-Term Value Creation, Guiding Principles for Corporations and Investors. And these really did focus on the need for U.S. public companies to develop a strategy for investing in the long term rather than for the short term. And what it suggested in this regard, TK, and I'm going to be quoting more or less from some of it, is that companies first need to define what their forward-looking incentives and measures of performance are, and that they be linked to a realistic long-term business strategy. So that's to begin with. That's the work the board and the company the management company have to do. that should be at least a 5-year lookout on how this is going. Then they have to communicate their long-term performance metrics to the shareholder community so that people will know how to measure them against their own goals as they go along. They should, in all likelihood, according to the Aspen Institute, they should avoid getting involved in the quarterly guidance game, not make quarterly performance estimates, and not get into guiding analysts as to how they're going to do in the quarter. And then, as Scott mentioned, they also should be able to make the case that their compensation plan is structured in a way as to support the long-term objectives of the enterprise.
Well, Stephen, let's take my example and say, okay, that we had 2 bad quarters and it did result in the stock going down, okay? And then subsequently there was a lawsuit that was filed on those people that had bought stock, prior to that period. Will the communication, to Scott's point, will the communication help in the sense that there was full disclosure? Then, Scott, with that, what happens to the compensation side of that now with the say on pay and whatever, that all of a sudden you might be rewarding executives who, now that we're down quarters, so everybody's looking at the pay for performance issue. So I'll start with you.
Well, the performance, remember, is a long-term performance metric. It isn't how you did last quarter. That is in terms of your compensation plan and also in terms of the company structure. But if the company has accurately disclosed what its long-term objectives are and how it is planning to meet those objectives, if it has told you that we're going to be making major investments in this emerging market in the next coming 2 periods, and it turns out, more or less as they said, it may be a little worse than they said, it could be a little better than they said, I don't know how anybody can bring a lawsuit about that or complain about it.
Well, we know people can bring lawsuits about anything, but
people can bring lawsuits about anything, but I don't know how you can win it.
Right.
And if you look at a lawsuit and you compare it, either it already contains in it what the company had been saying about its its performance and how it expected to do in the future, and then has allegations that line up against it. I mean, unless there is a deceit in the company's disclosures that can be highlighted and say this, they said this and it was not true, then I don't think a 10b-5 lawsuit is likely here.
How about comp, Scott?
Well, on the compensation side, agreeing with Stephen's point earlier, is that the compensation has to be directly aligned with the strategy. That strategy can be short-term and it can also be long-term, but that the compensation has to be aligned. The challenges that we saw in the financial crisis, particularly as it related to compensation, were that there were many compensation plans that actually rewarded short-term risk-taking, short-term results at the expense of long-term exposure to risk. And so the individuals were receiving excessive compensation in year 1 for maybe an investment opportunity that over 5 years lost a significant amount of money or put a firm out of business. And so, again, I think to the extent that those two are not aligned, that's where you're going to create problems.
Well, gentlemen, let me ask you this extension of that. So what specifically should the board be doing with this, knowing that they're going to have people that want to manipulate sort of their plans and stuff, not correctly manipulate, but that no one says that they can't come up with their own definition of things. But how solid does the board need to be, and how solid do they need to be on their communications?
Well, ultimately, as it relates to board communications, I think as it relates to this is more of a management communication. This is management communicating the strategy, the metrics, how you're going to be measured, certainly taking into account what shareholders may have to say about that strategy, listening to your shareholders, understanding those concerns, and making sure that those concerns are addressed in the context of that broader strategy. And the pressure is most likely going to be on, hey, we'd rather see those results faster or sooner rather than later, or we'd rather take our money off the table now than wait for those investments to pay off. That's always going to be the pressure, but I don't think that should impact your long-term strategy.
Oh, and TK, on this long-term, short-term, and public, we're really talking about public companies, because don't forget, there is an entire other marketplace there of private capital that routinely makes long-term investments whether it's 3 years, 5 years, 7 years, and is patient, usually, sets up compensation plans inside the corporation that very much incentivize the management to meet these long-term objectives. And they're not looking to meet quarterly performance goals. They're looking for the long term. And as Scott sort of alluded to, there comes a point in many companies' lives where, the long-term, short-term business has to, a long-term focus has to become a short-term objective if it becomes obvious that the way to maximize stockholder value and the value for the corporation is to engage in a change of control transaction. Then you're really looking at how much can I get in the short term. The person buying it is looking in the long term.
Doesn't all this touch to, from the board's point of view, Stephen, to the business judgment rule? And if a company or a board comes out and lays out, this strategy, in fact, they have the obligation to know that the company's going in the right direction. The board does. Isn't the business judgment rule so that somebody can't go back and second guess what's happened?
Well, I think it is. We're talking about the intersection of the business judgment rule and the federal securities laws, because business judgment rule is a state law fiduciary duty concept. And so clearly, if a board in good faith adopts a long-term strategy, and it's done it, as I said, in good faith and with a reasonable investigation, the fact that it fails will not be a cause for directors to be personally liable to the corporation. If it fails and they have misled the market about it, it could turn into a federal securities law litigation. But the key element there is deception, at least in a 10b-5 action. So if your public statements are not deceitful, if you tell people what your strategy is and how you plan to implement it, you should be okay in the long run. Now, there's only certain, you have competitive reasons not to disclose too much detail about what your plans are, or else the guy the guy you're competing with will jump in and, take the opportunity before you have a chance to exploit it. So there is that tension, but I think even courts recognize that tension.
Scott, it's funny how all this comes full circle back to what we've been saying all of 2011, which is the communication to shareholders.
It certainly does, and again, I don't want to undersell this, because I think this is a real challenge, and I think it's a real challenge that's created by the diversity of the types of shareholders that exist in the market today. And I think there's certainly a shift. You see it in the marketplace, you see it in how stocks trade today, that there's probably much more emphasis on short term than long term in the markets. If you're one that wants to know, hey, how is my stock going to trade on this specific piece of information right now, this microsecond? If you're a stock chart watcher, you're going to be pretty short term.
Yeah.
But if you're really looking at the sort of long term economic health of this country and the capitalist system, that sort of short termism is just casino gambling, and has very little to do with value creation.
Yeah. Well, this is a great topic, and again, this is a skill set of communicating out to this constituency that I think companies are just learning how to use effectively, whether it's telling them how they stay as an informed board, what their long-term plans are, or anything like that. So I have a feeling this will not be the only time that we deal with this communication topic. And gentlemen, thank you for joining us today. And that will conclude our show. I do have some quick announcements just for those viewers that are interested in the board education. We have corporate board member has the West Coast Summit and Peer Exchange coming up on February 29th and March 1st in Scottsdale, Arizona. That those of you that want to stay on an informed board, it's an excellent opportunity. And then, interestingly enough, in New York, we have back-to-back events at the New York Stock Exchange. Risk Oversight in the Boardroom is April 3rd. And Compensation Strategies to Build Shareholder Value is April 4th. So we hope that both the audit committees and the compensation committees can also take advantage of that opportunity that exists. So with that, that will conclude our show for today. We invite you back next week where we'll take another look at a strategic issue that will help you be a better board member or committee member. And we'll see you then.
Join us again next week for This Week in the Boardroom, brought to you by corporate board member and host NYSE Euronext. along with governance knowledge partner Paul Weiss and contributing partners National Investor Relations Institute and the Society of Corporate Secretaries and Governance Professionals.